I'm Jim Check. You're watching Kelowna Now. Today we're going to talk about interest rates. We have Ryan Berling from Rennie, and he is their head economist and vice president of intelligence. That's a title to live up to there.
I try. I try.
So why don't you tell us a little bit about yourself, and then we'll get right into it.
Right. Yeah. So I lead an intelligence team here. We're a team of researchers. Affectionately, I call us geeks. I've been with Rennie for 8 years, but been working in the industry for the past 20 here in Vancouver. And really, my group is really focused on using data to generate insights into the market, to support our business, to support our realtors, and also our developer clients, but just more broadly, consumers in general. We feel like more real estate's a little bit behind other industries in terms of leveraging data and technology, I think, to understand the market and to tell stories about it. So we're trying to push the envelope a little bit on that front. And for Rennie as a company, we are Vancouver-based, but we have offices in Kelowna, in Victoria, in Seattle, and we're a pre-sale business. So we do sales and marketing for new developments, but we also have a brokerage that has 300 advisors. So we're a lot of things, and it's a lot of fun.
Yeah, you guys have done a few of the projects here in Kelowna, like sold the pre-sales here, and I can't remember the name. Was Caban one of those? And
So
Fort
that would have
Crescent?
been no, we didn't work with them, but
Okay,
we're just entering that market now.
okay. So interest rates. We took the as in your note there. We took the elevator on the way up. We may be taking the stairs on the way down.
Yeah, I think so. I don't think that the Bank of Canada is in any kind of rush to lower rates. I mean, quite frankly, my feeling was that they should have cut in April. They should have begun cutting in April. So I think they're a little bit behind the curve. I mean, they were a bit behind the curve in raising rates too.
Mm-hmm.
And a quarter point cut was expected. We had been calling for that for about 6 months. Um, in my opinion, the economic data has really strongly supported a rate cut. There's literally, when you look at the landscape of data that informs a rate decision, whether it's the inflation data, and whether you're looking at headline inflation, core inflation, inflation excluding shelter, whether you're looking at GDP, whether you're looking at jobs data or consumer spending, literally none of those have pointed to an economy that is running too hot. We've had 4 months now of sub 3% inflation. And again, if you take out shelter, we're looking at, and the reason we would take out shelter, by the way, we're not cherry picking here, but the biggest contributor to the headline inflation rate right now is that mortgage interest cost, which is
Right.
rising. It has been rising by about 30% year over year. It's a small sliver of the consumer price index itself, but it's really punching above its weight because of what the Bank of Canada has done with rates. There's a feedback loop, and so we look at that and we say, well, let's remove that, because most central banks in the world actually don't include that element in their inflation calculation for good reason. So you take that out, and if you take out shelter more broadly, which includes rents, which have been rising rapidly, you say, well, why would you do that? Well, because higher interest rates have prevented first-time home buyers from getting into the market. So it's actually kept people in the rental market longer, these higher
Yeah.
rates have, than they otherwise would have been. And so that is creating demand pressure in that segment. So, we're talking a sub 2% inflation rate for everything that isn't shelter, like lemons to Lululemons, haircuts, which I wouldn't know about, but people tell me. Some people need them, but prices are rising pretty average basis there. So everything's pointing to the need for a cut, and we saw one, and we think that there'll be another one in July.
Yeah. So some of the political rhetoric out there is saying we have high interest rates because we have to fight inflation. But then the other, what you just said, we have high inflation that's mainly caused by, or partially caused by high interest rates. So it's kind of like a circular calculation, right?
It totally is. I mean, and if you want to include shelter and the mortgage interest costs more specifically in the calculation and just work with headline inflation, we've had 4 straight months of sub 3% inflation.
Right.
So even at that level, we're talking about pretty modestly rising prices. Now, I know, I know some people listening to this type of a narrative go, yeah, but life is so expensive. Things are so expensive. Like, how can you say, like, do the data really tell the story here? Are we missing something? And so here's the thing with inflation, we're talking about the change in the price level, the change, the pace at which prices are changing, not
Right.
the actual prices themselves, right? So,
Yep.
unfortunately, life is as cheap as it's ever going to be right now,
Yeah, people
right?
are hoping for deflation to get back to the old prices, but inflation is, for the common person, the inflation is the change from the previous period, and that's slowing. Inflation is definitely slowing. It doesn't mean that the
Mm-hmm.
prices have gone back to where they were when into 2020 and stuff like that. So I think a lot of people are expecting that to happen, and that may happen in some sectors, maybe commodity sectors and that, but I don't believe that'll happen in the majority of people's lives.
No, absolutely. And especially if you look at, um, yeah, I mean, if you look at the way that our economy is structured, mostly a services-based economy, and wages have been rising fairly steadily. We don't very often see wages decline over
Right.
extended periods of time for a whole
Yeah.
bunch of reasons. So, we're kind of baked into an inflationary environment, which is fine. We just want it to be low. We want it to
Right.
be, as the bank has said it now, somewhere between 1% and 3%. And you know what, we're there, and there's not very much at the moment inflationary pressure throughout the economy.
So mortgage interest rates affect rent and all that stuff too. But and Canadians, a lot of mortgages are renewing. A lot of people are super stressed. People are maxing their credit cards. What kind of relief can they see in the horizon?
Well, it's going to take a while, and again, this is why, in my opinion, we should have started the rate cuts earlier. We probably could be a little bit more aggressive than the bank is going to be, but remember that the Bank of Canada is biased. They will trade a recession tomorrow for inflation at target today, right? Their credibility is on the line. They're risk averse. So, what was your question again, specifically?
I'm just saying, what do we expect going forward? Like, when can the Canadian consumer mortgage holder expect to see some more relief?
Yeah, so I mean, it's going to be gradual, right? And so if you're on a variable rate mortgage right now, if you have fixed payments, you're not seeing any direct relief, like as in money back in your pocket. But if it's a floating rate, you'll see, for every $100,000 of debt that you're carrying, a 25 basis point cut puts $13 back in your pocket each month. So it's marginal, but it's moving in the right direction. I think for fixed rate mortgage holders, which is the majority of homeowners or borrowers, I should say, you're still renewing into a higher rate environment, even with rates coming down. So if you look at mortgage rates currently, like a good discounted 5-year rate at, say, like high fours. If you look at what the contract rate was 5 years ago for people who are renewing today, so you're talking like 2019, it was about 200 basis points lower. So it is really going to take some time for the accumulated benefits of the rate cuts by the Bank of Canada to really benefit fixed rate mortgage holders. And again, those fixed rate mortgages and the rates on them really respond to bond markets, right? And bond yields, government bond yields, which have been sticky. And I think what will bring those down is a demonstrated pattern of low inflation, and the Bank of Canada following through on lowering rates. So there is no like flip the switch solution here where people are just going to feel better. And that's why I don't think that this 25 basis point cut is going to ignite housing markets. I just don't. I think it'll give some confidence to some buyers who already could afford to buy right now, and now they feel like they're entering a market with some momentum. But we're talking, for us, we're looking at 18 months for the bank to get rates to a level that they feel comfortable with, which is to say probably about 200 basis points lower than they are now.
Yeah. So are you expecting a cut in July and September or?
So from the cheap seats here, I'd cut twice. My guess is they're going to cut once. For them to not cut at all would be a real long period between the most recent cut and the next one if they push it into October. So they only have 4 more meetings this year. So they've got, over the course of this year and next year, they've got I think it's about 15 meetings. So they'll be cutting, in my estimation, about once every meeting and a half. But again, there's like between now and July, to the end of July, the next rate announcement, there's another release of jobs data. There's more GDP data coming out. There's more retail spending data coming out. So I sit here from where we're now saying, yeah, we should cut in July. But listen, if the next job report comes out and says, hey, hold on, we've turned a corner, unemployment's down, employment is outpacing population growth. If we see retail spending turn a corner, well, that should change one's perspective on things.
Well, that last report was not good, though. The unemployment rate, I think it was 6.2, and then GDP continues to be weak.
Absolutely, yeah. The GDP figures are quite lagged, and so I suspect that the bank is fairly aware of what those numbers are going to look like, plus or minus. But the jobs report, for sure, that just came out last week was really weak. So I think you can kind of pick out what you want depending on the story you want to tell, right? So nationally, Canada added 27,000 jobs. You go, okay, great. The labor market's growing. But there were 28,000 more unemployed people. So the number of unemployed people grew faster than the number of employed.
We're adding to our population at an accelerating rate as well.
Exactly, and that's the thing. And this is why you've heard this phrase, a per capita recession. Canada's economy has managed to avoid a recession because we define recessions by what's happening in the aggregate. And the aggregate is being boosted by, as you said, tremendous population growth, unprecedented population growth. And if you adjust some of these metrics for a growing population, so look at things on a per capita basis, GDP per capita is down from where it was 2 years ago. Consumer spending is down from where it was 18 months ago. The unemployment rate, so if it's effectively adjusting for the population of the labor force, it's up by 1.2% from it was at 5% for a number of months at the beginning of last year, is now up to 6.2%. The employment rate, the percentage of the population that works, has been rising steadily for the last year. So you look at all of that together, you say, like, the underlying metrics, the performance of our economy is weak, but the flip side of that is exactly what the Bank of Canada expected and wanted. And that's where that bad news for us should be viewed on some level as good news, because it means that monetary policy is working. And it means that,
So the Bank of Canada, there's an argument out there that says they don't want to lower the interest rates because it'll cause the housing to take off again because we have such demand out there and low supply. But isn't that a political motivation where the Bank of Canada, is that part of their mandate to kind of like manage the politics of the housing supply?
It shouldn't be. It isn't officially. Their mandate is to maintain a low and stable value of the dollar. And a secondary mandate is to, if they can also manage low inflation, is to keep the economy at what they call full employment, which we're not at currently.
Right.
The housing market is one of many indicators that feeds into the rate of inflation. So I think it definitely puts them between a rock and a hard place. This is not easy to navigate out of this situation that we've created, because that because of a growing population, and not just a growing population, but a changing one. Like, life doesn't get put on hold just because interest rates are high. People still have kids. People are getting married, divorced, dying, downsizing, or wanting to. Kids are flying the coop or trying to. So almost like these social or demographic pressures build up, creating even another layer of pent up demand within the market that is in addition to the demand that accompanies a growing population. And so I'm not really sure how this is going to play out, to be honest with you. Like, I do think we're going to see additional price pressure, but
But
this is
that's
where
not their
then I think,
sandbox, though, right? That's not where they should be
no,
playing in the political arena and doing that kind of stuff, because there is political motivation to increase the population supply, which puts a tremendous amount of pressure on our housing supply. But that's not a reason for the Bank of Canada to go in there and kind of like manage that political narrative
yeah, exactly. I mean, they care about it only insofar as it makes their job harder.
harder. Yeah.
Yeah, which it
Um,
will.
a lot of, like I said, a lot of Canadians credit cards are
Yeah.
people aren't paying their monthly payments. There's a lot of stress in the
Mm-hmm.
market. Definitely when you look at some mortgage interests that are renewing, or mortgage renewals, and that they're renewing, and people are seeing, 50, 60% increases in their payments. And a lot of people don't have that room in their budgets. So some of the people are going to have to ride out this storm as the Bank of Canada likely takes the stairs down.
Absolutely. I mean, we are seeing, in BC, we've had the restriction on short-term rentals policy come into effect on May 1st, and we did see a surge in listings in the couple of months leading up to that. So, and if we look on the rental side too, we see a jump in furnished listings in some markets. So there's definitely a reaction to that in the market. But more broadly, high interest rates have led to this ratcheting up effect for inventory. More and more people are listing their homes, and we're at inventory levels that, like in Metro Vancouver, we haven't seen inventory levels like this in 4 years. In Kelowna, you haven't seen inventory like this since in 10 years, since June of 2014. And so I think there's the investor set that maybe has been riding variable rate mortgages for a while and can no longer stomach the fact that their monthly payments exceed their revenues. And it's just accumulated for too long that they need to try to get out from underneath that. But I think for homeowners too who are renewing, it's very tricky. Now, the one thing I'll say about that is, you mentioned credit cards. I think people will exhaust their other avenues for piling up debt before they start to address the situation with their principal residence. That's why we don't see mortgage arrears rates tend to lag other indicators over time. But I do think pressures are building. Now, the final comment on that is the B20 guidelines, the stress test in Canada, which we love to hate for those of us in the industry, or if you're just trying to buy a home, where you must qualify at an interest rate that is, call it 2 percentage points higher than the rate on your contract. Now, in a declining rate environment, you kind of look at it and go, why do I need to qualify at that rate if rates are going down or if rates are stable? But obviously, we had this unprecedented rise. And if you look at people renewing today, even though they are paying more when they renew, even with a lower outstanding balance, they are still operating within that stress test range from 5 years earlier. So it says that on paper, in aggregate, that people will be able to afford the renewals. Not everyone, but overall, they'll be able to afford it, especially when you look at over a 5-year period. Most working households would see, again, on average, an increase in income over that period. But it means that there's less money for everything else. So it means that these high interest rates are going to have a disinflationary impact on the economy for years to come. Because if I lock into a 3 or a 5-year rate term right now, that means I'm committing to paying however much more in my monthly payments than I was before, which means I'm going to have to cut back somewhere, right? Or pile up debt somewhere else. So ultimately, these high rates, even as they do come down, and even though people can technically afford them, they do act like a vice grip on the economy.
Yeah. So I have seen some developers on the pre-sales trying to buy the rates down, which ultimately encourages some people to make that purchase. Is that something you're seeing in the
Yeah.
Vancouver market as well?
we see a lot of different kinds of incentives. So buying rates down, or we do see some price discounts, but some allowances like furnishing or deck allowances, as they call them, as well, to try to entice people to purchase. But I think the biggest thing that we're seeing from developers is just a lack of desire or ability to launch a project, because it is so risky in this environment, to come to market with a product that you're not sure if the demand's there for. And one thing I'll say is that, as we look at the data, there is a very, very strong relationship in the resale market and the pre-sale market. And more specifically, it's price changes in the resale market that tend to dictate what happens in pre-sale. So if we see consistent price increases in resale, a couple things. One, it affects the consumer mindset of around prices. Because if you see a few months of rising prices, you start to think, okay, well, real estate is on the up and up. That's a good investment. $1 in today is worth something more later. Rising prices, though, are also in resale indicative of some kind of imbalance between supply and demand. And so if you go back to like 2021, when we saw hugely rising prices, it was because you had 50 groups going through a single open house, right? So one person would secure the home, and you have 49 groups that are kind of out in the cold, ready to buy, but maybe not able to. So some of that demand then spills over into pre-sale. We don't see those conditions right now in resale that are supportive of pre-sale. And so for developers, I think they're just looking and saying, like, hopefully, these rate cuts stimulate some demand that already exists within the market, and then there's actually a market for the products that are coming. And say what you will about developers, and people have different opinions about whether they should be making money or how much money they should be making, but we need new housing supply, and that is the conduit for new housing supply. So
yeah, in Kelowna, we were at that at the peak there. We were selling out projects in 24 hours, and now there's quite a few of them that are still trying to sell what they have left. And then most of the projects that have come to approval here in Kelowna tend to be rental projects.
Yeah, rental. There's a lot. There's especially there's some additional incentives that have been put into place for rental development. So yeah, we're seeing that in Vancouver as well. That seems to be across the board. And we need rental. I would argue that more than the overall housing market, the rental segment has been woefully undersupplied in our urban communities in BC for a couple of decades. We have seen more construction lately, but between 2/3 and 3/4 of people who move to this province they're renting in their first 5 years, right, before they actually put down roots. And they might be renting too because they're immigrants or here on a visa, and it's very, very difficult to purchase a home. And so if we don't have that rental supply, it's very hard to accommodate growth in our population. So we really need more of it.
Yeah, if you've got cash right now, it's kind of your market, right? To pick up, maybe as the inventory grows, maybe some good deals. But
absolutely,
people that are trying to sell, obviously, as that inventory builds, it's going to break either way, right? Either somebody comes in and picks that stuff up, or as people get more stressed, that'll obviously lead to some price decreasing, right?
Totally, and that's a good point you bring up, because we haven't really seen much downward pressure on prices. We haven't seen a lot of upward movement, but I think people haven't been stressed to the point of needing to offload homes at below market. And of course, the longer that the inventory sits there, and as it grows and buyers have more and more options, I think we'll see. We could be in for a period of price softening, depending on how the path of interest rate cuts goes.
So one of the political narratives too is that we need to increase housing supply, but increasing the mortgage interest rates really is, like you just said, choked off the supply side because developers aren't interested in building, and then so that's kind of like cut back on new supply coming to market, which then kind of, I guess, would stabilize the housing prices a bit at these high levels. So I think the rates need to come down a bit. I think our last bust was 2008 kind of thing. And
our last what, sorry?
Our last real estate kind of bust in the Kelowna area was around 2008, where we've seen some projects like sit there for years with just concrete blocks and stuff like that. I'm sure Vancouver Maybe not to this extent that Kelowna's seen, but
Yeah, and I mean, I just looked at data for Kelowna, and there were projects that had their financing and were able to build, but had lots of unabsorbed inventory that was on the market, which is way in excess compared back then compared to what we're seeing today. But if rates don't meaningfully come down and kind of grease the wheels of the market, yeah, we could move back into a period where we're seeing, to your point, concrete shells of buildings or finished buildings with more unsold inventory going forward. But I will say, I think that's a fairly, from the vantage point I'm at right now, and this isn't, I'm not blowing smoke or trying to be overly cheerful about the market, because it has been a pretty depressing 2 years, and I'll be pretty straightforward about that. I just think we're in for a period where rates do need to normalize, and the bank also knows this. The bank acknowledges that its current rate policy is restrictive, and honestly, even if it moves down, we have been forecasting a 100 basis point cut to the policy rate by the end of this year. So we're 25 points into that. So we're expecting another 3 cuts in the next 4 meetings this year. If we end the year at a 4% policy rate, that is a restrictive interest rate, right? The bank, has identified that somewhere between 2.25 and 3.25 is where they want to be. So take the midpoint, call it 275. Well, that suggests then there's another 200 basis points on the table to be cut in, I'd say, a fairly short period of time, like call it 18 months.
what effect do you think an election, which is still about a year and a half out, will have on rates?
The federal election?
Yeah.
Um, I don't think it has a meaningful direct impact. But I do think that one big change that might accompany a changing of the government is around immigration policy. We've had the current government has been pretty aggressive in setting permanent resident targets at ever increasing levels. And there's a fairly strong economic case to be made there that we need to bolster our labor force as we have an aging population and a below replacement fertility rate. But what has sort of gone under the radar is the number of visas that we've been issuing to students and temporary workers in recent years, which just totally dwarfs the number of PRs that are coming in. So currently our permanent resident targets are moving up to 500,000. They've kind of been escalating stepwise. Well, last year we issued somewhere just over 1.2 million visas for students and temporary workers. And again, you say, okay, well, great. The students can come in, study here, and become PRs, or the workers are filling gaps. And that is true. There isn't sort of a blanket statement that it's good or it's bad, but it is an unprecedented number. And it puts tremendous pressure on our infrastructure, transportation, healthcare, housing. We cannot keep up. We simply cannot keep up. And so the federal government finally acknowledged this recently, and has now they're limiting the number of student visas that they're issuing, and they have a goal now to reduce the number of non-permanent residents, so people on visas in Canada, from the current 2.7 million down to 2 million by the end of 2026. So that's significant. But I suspect that if a conservative government were elected with a majority, I suspect you will see a ratcheting down of the number of, as a matter of policy, the number of visas that are issued, so working and student. But also, my guess is that the permanent resident targets would come down too. So all of that is to say, I do think a change in government in that respect could impact the housing market. And I think it would actually take some of the heat off of the supply pressures that we have.
And then there's some political pressure from down south. I think Donald Trump is running on the premise that he will do the biggest massive deportation in the United States history of 30 million people. How many of them would just flee to the north instead of getting, deported?
That's a great conversation to have over beers.
I mean, that one
uh,
scares me because if we have like if they go on this massive deportation thing and then people are just like, I'm not going back where I came from, and Canada's borders are wide open, like that's like, that could have the potential to increase our population by 50, 60, 70%. And we can't even deal with what we have.
Yeah, I mean, the extent to which people might scatter to avoid deportation, I don't know. I don't have a
Mm.
sense. My guess is that he's probably um, blown a little bit of smoke there. Like he might have an intention to do that. I doubt he would fully follow through on something like that. But if he did, I think we need to have a strong border to be able to, like, if people are coming to the border and as who they are, and saying, hey, we're refugees, we're seeking asylum, whatever it is, we also have to have a way to manage that flow of people. So, I mean, I don't have a strong opinion about what that will look like, but it's a bit of a wild card.
Housing definitely is a big concern for everyone. You brought up healthcare. Those are the two of the bigger concerns in Canada. Housing, whether that's rental or buying a home, and then health access to healthcare. Those are all things that are worrying Canadians. Obviously, the debt load, the inflation, and thanks for taking a peek at that for us. And we'll check back with you maybe in the new year, see if we got our down point for the year, and then see what happens in the following year.
Yeah, I would love to join you then. Hopefully, it's a bit of a different discussion, and there's a bit of a clearer path forward for rates. It's a more stable economy, and hopefully, for all of us, a more stable housing market.
Yeah, because 2020. I'll leave with this. In 2020, it seemed like everything was kind of just prior to COVID. Everything was just kind of like people are expanding businesses. Like developments were happening once a week, and everybody seemed pretty happy and everything. And then now, like obviously COVID caused a lot of problems, but some of the policies that were put into place, I think, exaggerated some of those problems. And now we're really feeling the hangover from all of that, and people are just trying to hang on.
They are. I mean, it was the economy was not out of balance leading up to COVID. So it's a really unique situation that we found ourselves in, with everything being shut down to start, and then the consequence of some fiscal policies as well, leading to a run up in spending and inflation. We went from historically low rates to high rates, and it's just been a total roller coaster. So uh, I would like things to be a little bit more smoother sailing as we head into 2025. And my guess is, from where we sit now, that it will be.
All we can do is hope for a better tomorrow. How's that?
Sure, sounds great.
I thank you for your time, Ryan, and you have a great day. And let's hope for some more sunshine.
Sounds great. Thanks, Jim. It's a
You bet.
pleasure.
And thank you for watching Kelowna Now.